I've poked the bear there, haven't I?
Yeah, 2% on $1 million property, what's that, $20,000 in a month?
Yeah.
That's the rate that you have to say that.
Yeah.
Because that's kind of the pace that the market is moving at the moment in some of the areas.
For your short show, it's property investors. That's why house prices have gone up.
It is. Isn't that the, I think that's pretty much the narrative from the government at least. But the truth is, renters are outpriced of the market because they don't have the ability to buy property. They have to rent.
Yes.
If investors aren't there, where are they going to rent?
That kind of gives the government a bit of a get out of jail free target when you talk about their promise to build 1.2 million homes over 5 years. And, spoiler alert, it ain't going well.
Welcome to another episode of the Lazy Equity Podcast. Today we are humbled to have a good friend, Mike Mortlock, in studio with us today. Mike is from MCG QS. He's the director and owner of the business. And going to be talking about a few characteristics that are inflating the house prices of Australian property markets today. Thanks, buddy, for joining us. It's nice to have you in again.
Thanks for having me.
You're welcome.
For your short show, it's property investors. That's why house prices have gone up.
It is. Isn't that the, I think that's pretty much the narrative from the government at least.
I think that's what I'm taking issue with, right? We're heading into the May budget, and I see you've been doing some great stuff on CGT and negative gearing, educating people on that.
I just want to put a little disclaimer on that. If you ever do speak about anything like that on Meta or Facebook, try not to mention the government. It doesn't last too long.
I've poked the bear there, haven't I?
Yeah, no, you're good. Carry on.
Yeah, look, I think the politicians would like to point to property investors, and that's been sort of a convenient whipping boy for a number of years. Probably 2 elections that we saw the Labor government going to the polls with the CGT and negative gearing changes. Obviously, that didn't work. It's different now because they've got the numbers, right? So people are saying, okay, well, if there's ever a time to do it, it's now. But there's 2 ways to read that. Now is the timing from a political might, like they've got that upper and lower house dominance. But in terms of timing, if we're talking about like 1.3% vacancy rates, like is this the time to disincentivize investors? I mean, it's probably too big of a topic to go too far with it, but I think there's a lot more behind the scenes we need to unpack first.
I'm happy to start unpacking that. I think you've hit the nail on the head there. There's far too much of a narrow sight on really what is inflating property prices. And this capital gains tax implication, when it gets announced, if it does get announced in the way that we're expecting it to, I just can't see how there is any real substance of a thought through process for this to actually materialize into something that actually does stop house price growth. Can you see any outcome from it eventuating?
Oh, look, I think some people have got enamored with the idea about, it's fixing the inequity of the original system, right? Because it was the old indexation model. And now they're sort of saying, look, to get to 50% CGT exemption, you kind of got to have about 16 years worth of inflation. So we need some reform to make that work. But the property market is so fundamentally different now than it was in 1997.
Exactly.
Like that point to me is quite moot. It's baked into what we know the housing market to be. The unintended consequences are a little bit concerning to me, and that's why I've sort of tried to shift the narrative away from one obvious situation that kind of gives the government a bit of a get out of jail free target when you talk about their promise to build 1.2 million homes over 5 years. And, spoiler alert, it ain't going well.
No, absolutely not. I think you're perfectly right there, where the landscape of property investing is not what it was 20 years ago. There was not a population movement like we have at this current time and day. There was not the costs of building and developing like we have today. The labor isn't what it was then. It's very different in the landscape, and all these things start to play a point in basically creating more costs in the desire of trying to buy your own home. And whether it's a new build or an existing build, a lot of those home purchasers and investors as well, they don't want to go and put a shovel down because there's so much cost associated with putting a shovel down. So they want to go and make their securities off established properties and products. Yeah. And part of that is, that's basically creating, I wouldn't say it's creating a problem, but there's a resilience here that we need to create ourselves. And not having the aid and the support from the government means that we have to figure it out for ourselves. Had the red tape, which I'm sure you probably saw my little rant on social medias, had that red tape been lifted around the capital gains tax, or rather the constructions around being able to build properties at an effective level and rate, then there would be far more new builds coming into the market, and there would be a lot less pressure on the existing markets. And that's where we really are getting a lot of the pressure from the governments at the moment, is that they're pointing the finger at us.
Yes.
Renters are pointing the finger at us. But the truth is, renters are outpriced of the market because they don't have the ability to buy property. They have to rent.
Yes.
If investors aren't there, where are they going to rent? They're going to be on the street.
Yeah.
The fundamental problem here is a structural alignment from the governments to really understand that if you want to put people in houses, you have to make the houses available.
Yes.
So the bottom line.
Yeah. And there's two ways to do that. You could have property investors to provide housing supply, or the government could be meaningfully invested in public housing. Those days are gone. They own somewhere around 385,000, public dwellings, but we have around about 3 million dwellings as a requirement. I think there's some stats to show that, if we go back 20 or 30 years ago, about 10% of new builds were going into the public housing fund. Like now these days it's closer to 2%. Wow. So it feels to me like they want to have a debate about whether housing is an investable asset class, right? And I'm up for that debate, but when we have an alternative, when we actually have a solution, the government is really out of the public housing business. So we don't have those safety nets in place.
Great point. Actually, I hadn't even considered that before. So then what's the argument there? Where do they fall back to?
Well, I mean, you might remember the political discussion we had in New South Wales talking about the poles and the wires, right? Privatising big energy infrastructure. I feel like the government has privatised public housing, right? Or at least, rental accommodation, roofs over people's heads. And now they've sort of got to the point where they've said, okay, well, this is what you can do. These are the incentives. Now we're up to a point where the private sector has done very well to replace public housing, but now it's sort of like, well, they are actually the problem now. But really it was the government that was in control overall. But getting back to that supply point of view, there's a few different ways to think about supply. I think the household formation rate is an interesting way to think about supply. So we can see that that's increasing. We're sort of getting up from 2.4 to 2.6 people per dwelling. I would expect that to have to increase because we're in a situation now where, income to asset price is 6 or 7 times rather than 3 or 4 times as it was 20 or 30 years ago. There's a lot that sort of comes together that really has exacerbated this problem. And to me, like the first big statement from the government of that 1.2 million homes over 5 years was a big statement, a meaningful thing that should have made a big difference to the supply that we have in Australia, but they've failed on that target. 1 July, we actually hit year 3 of that 5-year target.
What's the biggest reason, do you think, that we've actually missed that target so badly?
There's probably a few factors. I would say that we were trying to do that at a time where interest rates were a little bit higher than they were historically. There was a huge amount of construction insolvencies from COVID, and it continues to happen. We're talking 2026, there's expectations of about 3,500 construction companies. When we're talking about insolvencies, the construction businesses are the top of the table of any particular industry. We haven't invested enough in trades, so labour is a big one. So May budget last year, I think if you were an apprentice tradie, you got $500 for tools. These are not big incentives. There were incentives to bring on apprenticeships, but we need probably more skilled labour than just labour, right? And that takes some time to come on. There's been some insights about unions blocking skilled labour from entering in the country. We've also seen, since that announcement, the 1.2 million homes, we've seen quite a lot more immigration than I think was originally planned for, and that's a whole nother thing, and I think without the immigration we'd be in a per capita recession, so we need to do it, but it might actually make that 1.2 million out of date. I think regulation, planning, taxation. So if you go pre-COVID, a dwelling like a house would be 7 to 9 months construction time. time frame. It's now more like 10 to 12 months. Construction costs, I think a lot of people are pointing at construction costs as being the big problem. December quarter 2025, we saw a 1% increase in construction costs, which is actually up. Annualized, that's 4%. And that's really the pre-COVID sort of decade average. So construction costs aren't rising rapidly now. With the war in Iran, especially diesel, which has a big implication on construction costs, material price inputs could be back on the agenda. But it was just that really rapid rise of construction costs during COVID, when we're talking about 30% really in 2 years. And of course...
Yeah, that's scary, isn't it?
It's big.
Like the increase of that value, it puts so many people that much further behind. It's far too fast.
Yeah.
I mean, we are in the business of buying high-performing investment property. But to be quite honest with you, our business model likes to stay still. We don't like to move around aggressively because that's kind of what this is actually causing us to do, is that we have to find new markets all the time. And luckily we have Crystal that helps us to do that, and this is probably one of the biggest reasons that we built Crystal. But at the end of the day, like, you really want to have a stable understanding of the landscape where you're buying property. The pace that we now have to pivot to be able to support the business's operation for our clients, to make sure that we get the right growth for the longer amount of time, so that affordability doesn't necessarily just come in within months, which used to take a couple of years. We're now looking at the half the amount of what unaffordability would have taken previously. It's become such a huge amount of equity growth in such a short amount of time. That's just our business model, but it does show that there's obviously beyond the business, there's also people who are taking strain around this, and it needs to be wider understood.
Yeah, well, I think like consistency is a good point, right? And that sort of weaves its way into the CGT debate. Like, when we went to those two elections with negative gearing and CGT, with Pippa's survey, they were sort of saying, look, there's a reasonable sized cohort of people that are considering exiting the market just because they don't have continuity of policy, right? If you're investing in real estate, you want kind of the rules to be what they are today, the same in 10 or 20 years. And now with the CGT, a lot of the analysts and the Grattan Institute especially are saying that it shouldn't be grandfathered. So that's kind of like people have already transacted in a market and this is going to retrospectively impact them. But I suppose what they're looking at is just that intergenerational wealth that sort of exists with some of the baby boomers. Like if that's being grandfathered, then they continue to sail on to into the sunset, where the focus has been first home buyers.
On that point, like, let's actually look at what the government's done to support that first home buyer stimulus. I don't think there's been enough around that. Again, just markets are just outpacing what these people can afford to save and contribute towards purchasing. The incentives that are put in place seem unrealistic for being able to live the lifestyle that you traditionally were as a renter, because they push you out into these areas where they don't really support your lifestyle or your work or your employment. What's your take on all of that?
Well, I think we've been kicking the can down the street year on year with first home buyer incentives. Like, I think as Australians, we value home ownership a lot higher than other countries. I think that's an important Australian value. When we talk about housing affordability, we only really talk about, can a first home buyer buy a house? We don't talk about rental affordability. And really, we had 25 years where rents didn't outpace inflation, right? But then we saw such a rapid increase in rents that it's not necessarily the price of rents, it's just that rapid increase that really stung people. But you look at the traditional sort of first home buyer placements, they're normally capped around 40,000, and it varies from state to state. But that October legislation that was brought forward, so basically uncapped first home buyers to get into the system. I was speaking to a buyer's agent that works exclusively in Brisbane, and they said basically it went up 50K sub 950 price bracket in a month. So 30 days, we're talking over $1,000 a day. And that's the situation that we have to live with. There's been so much stimulus at that bottom end, and it's great if you're one of those people that qualified for it, if you got one of those 40,000 places. But let's just say it's uncapped now and you were in 40,001, well, you might be saving for your deposit and you're like, I need another 6, 12, 24 months. The property that you were looking at at now compared to 24 months down the track, like it's unaffordable.
2% on $1 million property, what's that, $20,000 in a month?
Yeah.
That's the rate that you have to say that.
Yeah.
Because that's kind of the pace that the market is moving at the moment in some of the areas.
Yeah, and who's able to do that when we've got such an increase in rents, right? Yeah. Like if you look at yields...
And wages aren't keeping up with that.
No. Yeah. I mean, we've come off some fairly good wage price growth in the last little while, but now for the first time, really from an Australian-centric point of view, we're starting to see a lot of job losses due to AI. So that's a really interesting one as well. And I'm sure, like, you're a tech wizard and you know, but really February with the release of Anthropic's model and Codex and that sort of stuff, we did see like a rapid leap in that technology. And, you know, you only got to look at businesses like Atlassian that have just announced big cuts, the share prices in the toilet, you know, it's battle stations there. So there's some economic headwinds. And of course, you know, we recently had the 25 basis point interest rate rise as well. Yep. Predictions are more to come, especially if the war in Iran becomes protracted and we can't get the Strait of Hormuz open. That flows to a lot of things in the economy.
It will, and there's an expectation that that's going to hit quite quickly up to the 5% mark. I wouldn't be surprised if the next announcement is 0.5%. You know, we've seen it before, and I think the requirement to get people to stop spending at such volatile times, I think, is necessary. I mean, we'll see what it does. Historically, it hasn't always had that much of an impact on property prices as a whole in Australia, and I just want to sort of touch on that a bit, because what we've always noticed is that when interest rates go up and down, it doesn't really make a property investor less interested in buying. It just pushes them into a different market. And when you're pushing people into different markets, which is kind of where we are these days, and this is part of the comment that I made earlier where property market growth is just so eruptive at the moment, it's just so fast, is because we're on a financial playground with a seesaw that keeps on going up and down and up and down, and it's just moving markets around. Where you would be able to spend your $1 million these days is going to push you into a market where you then have to consider an $800,000 property. Yeah. And that's just really a nature of the demand that you, or rather not you, but the market in general will have to adapt to because of affordability. Everybody knows safe as houses. You know, there's a saying obviously around it. Saying, you know, it's safe as houses, but it is true. I mean, when you're looking at Australia and the population and the amount of property that we need and the rate that we're growing at, it is going to be a safe as houses situation for quite some time. Unfortunately, in the Middle East at the moment, we've got really horrible things going on. Australia is one of the safer countries to retire to. And there is the expectation for more population to be gained due to this. There's a lot of people that we know that are actually coming back from the Middle East due to, you know, these conflicts. And that's not just going to be internationals, it's also going to be Australians coming home. And that's the reality, is that they are absolutely allowed to and should be coming home. But where is the support for that? So while there's still going to be the need and interest rates will still come up and go down and whatever they're going to do, it really just moves investors to different markets. And I think there's an oversight in that there being an act of the investor pushing up prices again. This really just comes down to shortage. Yeah, and I mean that's where we get back to supply. We come right back around to the beginning, and we saw, like, in the December quarter data, around about 40,500 completions. So on an annualized basis, we're talking 162 odd thousand. If your maths is good playing at home, we need 240,000 a year. So 1.2 million divided by 5 years is 240. Like, we've really only ever nudged that once in history. And why I said from that announcement that it's over before it even begun is because construction costs had increased. We saw the insolvencies, and then one thing that we need to also understand is the absolute behemoth of public infrastructure spending. So, you know, infrastructure spending, according to Infrastructure Australia 2025, is about $1 trillion for the next 5 years. And you haven't got to sort of look around the country too much. Like,
here in Sydney. We've got the Sydney Metro, we've got the Melbourne Metro. You know, we had the Brisbane.
Soon to be Newcastle.
Yeah,
potentially.
Well, the train. You know, like there's a lot of consultants fees there.
Yeah, I know.
We got the second airport. You know, there's the Queen's Wharf stuff in Brisbane. There's been huge infrastructure spending, and that is actually competing for the residential property market for trades, right? So we're trying to build these homes. We need the labour force. Infrastructure Australia is saying by 2027 they expect a 300,000 personnel shortage in the construction industry.
That's so significant.
Yeah.
How do you even come back from that? I mean, you really just have to ship people over.
Yeah. Well, we need about 87,000 today to be able to track to that target.
And this is literally the problem. You need people to build the houses, but those people then need to come to the country to build the houses. Where are those people going to live? Not in houses. So what do we do? The red tape just needs to be lifted up.
And that's a problem as well. Like, if we talk about productivity, I mean, there's planning, productivity. Alan Kohler had a great graph where he showed the rise of town planners, and the dwellings produced per town planner has not actually improved, even though we've seen like a 20-30% increase in town planners. And that really just speaks to the complexity, right? It is very, very hard to bring new housing stock, and then the developers have got to have the finance risk. And when we talk about supply as well, it's like houses aren't doing terribly, but it's the volume, the high density stuff that's really coming off. And those are the sorts of projects that can bring you know, big housing on. But it's also got to be the housing that we want too. Like when we saw that affordability, or let's just say the apartment oversupply, these were more sort of 1 and 2 bedroom units. I think we actually need supply that's fit for families, you know, 3 bedroom properties and those sorts of things. But they're just not stacking up, and the risk associated with construction over that big time frame is a big one. I mean, during COVID, we saw the government come in and guarantee bank deposits. Like there's opportunity for the government to be able to guarantee developer finance, or just innovation in and around something that helps with productivity as well. Because if you look at all sectors in Australia, productivity's in the toilet, but it's about 2%, right? Construction sector's 0.4%. So there's so much that can be done. I mean, we've been talking about cross-laminated timber, we were talking about shipping containers, modular, you know, precast, all that sort of stuff. But we still have banks that don't understand it and can't finance it. So we have to solve a lot of those problems, because I just mentioned before, construction costs aren't really rising rapidly, but the construction time frame, which has a cost, and the labour is a problem. But these construction methodologies are faster and they require less people. But the construction industry's difficult. We like to think about it as one big thing. Certainly when the CFMEU is in the news for their criminal activities, we kind of think that it's one big industry, but it's made up of a lot of subcontractors that are small businesses that don't have the ability to inject millions of dollars in R&D and those sorts of things. So that's where I think the government can meaningfully help with the supply.
There's this, you've probably seen it on Instagram or social medias, but there's this truck 3D printing houses thing done at, it's actually a Melbourne company that's invented it. Have you seen it?
Yeah. I saw it on.
It's all in the US now.
Right.
Yeah. So, well, they've developed it there, but it's building houses in the US. I don't think it's happening in Australia yet, is it?
No. Look, I did see something on the news about that particular company, and there was one family that had their dwelling built, and it was about a third of the time. But they found it difficult to get that through council. They didn't understand it. They'd never seen it before. Financing that. I mean, that's where the government has power to be able to push in those directions. But what are we doing? Like, we're spending $10 billion on the housing fund that's to deliver 40,000 homes. AFR came out and said that we've delivered about 2% of that so far over the 5-year target. So even the government themselves are finding it difficult to bring on new housing when they don't have the same financing issues. They probably don't have the same planning and regulatory headaches that the private sector does, but they're just not bringing it on fast enough.
Okay, so we are talking about house price growth, but there's also the investor side that we're looking at, because we are obviously an investors agency. When it comes to buying an investment property and you're insuring it, this growth that we've experienced, there's obviously going to be a lag effect here from the valuation that you insure your house for compared to, a couple of years later, what it's actually worth. I think you've got some decent figures on this around what those actual values are short.
Yeah.
And it's quite staggering.
Yeah.
How much trouble people are actually in.
Yeah, well, firstly, the Insurance Council of Australia, I think, said that about 89% of property owners are underinsured. We ran our own analysis because we prepare replacement cost estimates for insurance purposes. So how much would it actually cost to rebuild this, which isn't just the construction cost, it's the demolition, it's the time frame, it's cost escalations. It might be something that doesn't meet zoning or BASIC's requirements or whatever it might be. Across the board, it was 24% underinsured on the value. And where does that come from? Well, so much of I believe comes from valuers who give you a market valuation and then they will have a replacement value in the back end. And now, if you've ever read the fine print, it says basically you can't rely on this, you need a quantity surveyor to do it. Begs the question, why do they put it in the report? I actually think that they need to stick in their lane. I'm not qualified to estimate market values because like a building has land underneath it, and I'm not qualified to estimate land. I stick to the nuts and bolts construction stuff.
Yep.
They're qualified to do the land and the sales value, but not the reconstruction. And if you just think about, you owned a property and it was $1 million to reconstruct in 2019, and then COVID happens and you're 30% out already. So people are just CPI indexing these policies, and we've sort of really almost like come up with a new tagline within our business. So obviously we do tax depreciation schedules, so we talk about maximize, and then we're actually talking about protect. So, so many people put so much effort and energy to build a portfolio, and I believe it's a very admirable thing to take control of your financial future. That's part of my sort of issues with the federal government demonising property investors. They're just people that are trying to dequalify themselves from the age pension, right, which has a cost. We don't talk about that as well. But if you're going to all of that effort to build that portfolio, you want to make sure that it's adequately protected from anything that can happen. Of course, Mother Nature's been getting a little bit angry. There used to be a big climate change debate. I think most people are aware that it is a serious thing. The extreme events are far more common, but it can also just be an accident. Someone can drive their car into your house. You can have a fire. There's a million different things that can happen. And the stats on underinsurance are big, and I've taken that on as a little bit of a passion project as well.
Yeah, it's quite scary. I mean, that's a large amount of money. But even more scary is, I think, the policies that are attached to some of these, or rather the clauses and terms inside some of these policies, like the co-insurance clause.
Thankfully, that's a commercial policy. But I'm speaking at some events coming up, and I wanted to sort of flag that, because if that enters the residential space,
so that's specifically commercial.
Yes.
Okay, I thought there was an option for co.
Well, you never know with insurance companies. I mean, like, insurance has been a huge part of inflation in the last couple of years. Anyone that has an insurance policy about anything would have seen some huge increases in that. And I mean, even the Strait of Hormuz is an insurance issue now, because the insurance companies are not insuring these ships to run the gauntlet off the coast of Iran. So I look, will it come into the residential side of things? I don't know, but I want to flag that as a potential risk. And even if it just scares people into action to make sure that they've got a policy that adequately covers the reinstatement, then I'm fine with that.
Yeah, and just extending on that actual policy that we're talking about, it's around the fact that if you are insured for whatever the value of the property might be, it's the damages that occur to the property, the difference in your value that you've insured for versus the value of the extended damage is the percentage change from your policy payout. Is that right?
Yeah, it's a bit of a
tongue twister.
It's a tongue twister, yeah. But like, so it basically cuts in at 80%. So if your place is worth $1 million to rebuild and you've got insured for $800K, you're 20% behind. So what that would then mean is that they will give you 20% less than the $800K that you insured it for. So you might have insured it for $800, but they're like, well, no, you elected to have this property underinsured, so you're carrying that that risk. And let's say you're 20% underinsured and you incur 200 grand worth of damage, you're only going to get 80% of that value there. So that's a very sneaky little insurance clawback.
Nice insurance little tactic there.
Yes.
But like you said, that's commercial, right?
Yes.
Yeah.
Okay.
So we don't see that yet so much in residential. Okay. Interesting.
As at the time of recording.
Anyway. Mike, thanks so much, mate, for coming and spending some time with us again today at Lazy Equity Podcast. We always love having you over and your insightful commentary on what's going on inside the market. It's definitely refreshing knowing that, there's your passion around property data, which is stemming from the accounting side of things, I know it's grown from an annoyance of just not there being a real understanding of the full climate and the full ecosystem. I think that's why we always have so many good chats around what's going on with the data inside the markets. And thank you so much for coming
it's
through.
A pleasure, and I love your insights as well. And I think when we can weave all of the data and the on-the-ground sort of narrative, we get a really good picture of what's happening in property. So I love sharing the stories with you.
Thank you, mate. We'll always appreciate your time. Thanks, guys, for joining us for another episode of the Lazy Equity Podcast. Until next time, have a good one.